Folks, happy Memorial Day. Happy Monday Night Futures Live. And we want to kick the show off, of course, with a tip of the cap to our fallen warriors and all the wars that has allowed us to live the lifestyle that we lead. God bless. And hopefully we don't see any more deaths in the future, but we know that is an impossibility. So happy Memorial Day. So let's begin with sound check. Audio okay? I'm going to assume it is because I haven't heard anything yet. So let's get to it. So we have a lot to talk about tonight, and it's kind of a twist over the past several live streams where we don't want to be too bearish all the time. I keep talking about a lot of the bad news that's out there. I still think stocks are going up for now. And we're going to talk about the whys behind that. And one is going to be surprising to many people. The other is going to be a more technical possibility out there that began last Thursday with a big outside reversal bar on SPY, QQQ, whatever chart you're looking at. It was a broad-based sell-off. As a matter of fact, it was the first time in a very, very long time where every single Dow stock was down on the session. So it's not an insignificant day, and Thursday is not over yet. We could still get a follow-through to that price action. So let's talk about the futures action here a little bit, because the futures were open today. And I'll read off obviously it was on very, very light volume. It was an abbreviated session closing at, I believe, 1 p.m. The NASDAQ 100 up spot 40%. E-minis up 0.29%. The Russell 2000 up 0.69%. Big day for the Russell 2000 today. Silver up 4.4%. Gold up 0.77%. U.S. dollar down about a half percentage point, and oil up over a percentage point. So big day across the board, equities and for commodities. Why? Yields were down, I think, by about 0.4% thereabouts. So we have the E-minis open now. And I'm kind of confused here a bit because they're showing is down, but we're actually lower than where we closed. So I'm not quite sure how they're calculating this. We're off session highs, which is probably what they're doing. We made a new higher high and we reversed. I hate that. I like to go by the prior session close versus to where we're at right now. Not this gap up. That's your high starting point, and then you fade off of it. It drives me crazy. So right now, technically, day over day, E-minis are down relative to Monday's price action. We're now into Tuesday in the futures. Taking a look at the NQ, NASDAQ 100, it was up 0.40% in the regular session. And it's showing that we're up another third of a percent. Maybe they're calculating in Monday's percentage gain, because now we're fading. We're certainly not down a third from where we're opening. I think what they're doing is they're subtracting. Let me check this out. 527. 527. So yeah. So they go, this is a continuation of today's price action. That's what they're doing here. Okay, now I understand. So we are still up on the day, but we are well off the highs of the day on the NQ. RTY, Russell 2000, still up nearly 0.6% on the session, but obviously coming in off the highs. Let's say hello to folks. Thank you, sir. Appreciate it. Ramon, good evening, Bob. Want to mention Fossil. I saw your message when I get a glimpse of the messages before I go live. And I pulled it up. I actually have, I took a look at the chart. We'll go over it. I also pulled up the fundamentals of Investors Business Daily, and we'll take a look at the fundamentals there because interesting EPS change there. So let's jot that down. Fossil for Ramon. Okay. Let's go to the dollar. The dollar was down all day today, and it's continuing down lower. And that's because of euro yen. Both were up earlier today. And it's if euro and yen are going to be up, dollar can't be up. So euro is still up, and it looks like we're setting up here for a breakout. Yen setting up nicely here. This is a 30-minute chart. Setting up nicely. Let's check out the day, a 4-hour chart. First, then we'll go to the day. Very tight setup here. Bullish on the yen. We broke out of this downtrend channel. Here's your upper band. We broke out. Still could do some backing and filling here, but looks somewhat bullish. Let's take a look at commodities now. As a matter of fact, let me pause here. I didn't go say hello to everyone. Mr. Pete, welcome. Franklin, Bob and crew, hope you had enjoyed your weekend. I did. Thank you very much. Lots of time in the pool this weekend. Dog down to the beach, relaxing. TF Hatter, welcome. Jeffrey, welcome. Oh, I'm sorry. Thank you. Thanks, Franklin. That would help, right? There we go. Thanks, Franklin. As always. T1 starts tomorrow. Do you see any pressure or effect this may have on trades? Oh, I doubt it. I doubt it. It's a good thing that it's happening, though. It's about time. Thanks, Gay. Thank you. Okay. Trader Isaac, happy Memorial Day, pal. Okay. Let's continue on. Let's go to the U.S. dollar. Actually, we did the dollar already. Let's take a look at energy first. So energy, oil, up, still up over a percentage point on the session. Bitcoin had a good day today. It's coming off the high zone. Natty gas pulled back last week, but now nice up session today. Off the highs, but an update nonetheless. Copper took a breather last week, and we are bouncing here. Let's take a look at the 4-hour chart. Do we have a setup? I don't know. I'm getting the vibe that this is a head and shoulders setup on copper. We're back above that trend line here. Here's the neckline. We're still not back above there. Here's your left shoulder. Here's your head. Here's your right shoulder. What I want to do is I want to do this. I want to know when we break. If we break, we may not. Could certainly continue up higher. right, so that's copper. Let's stick with commodities. Energy, RBOB, gasoline prices. This is a 4-hour chart. A very strong day today, up 1.21%. Silver, up 4.3% on the day. Amazing. Let's check out volume on the day, though. Very, 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 very thin volume. It's funny. Here now this is saying it's 528. Very strange. Let's go to GC, gold. Gold up 0.81%. This may go up higher, especially if the dollar pulls back further. Gold may press higher. A lot of damage has been done here on gold and silver for that matter. So I don't know whether or not we're out of the woods yet on these names, but certainly the weakness in the US dollar, if it continues, is going to help. Live cattle, weekly view first. We broke down a couple of weeks ago the question that we have to ask ourselves: is this a check back or a retest of prior support? Will it fail? That's the big question. Given that the head of cattle in the United States is like lows not seen since the 1960s, this could probably continue up higher. Let's check in with ag. Now, one of my favorite plays for June is going to be soybeans. And soybeans, I'll go to the seasonality on TrendSpider in a moment, but we'll go to corn first. We're going into a very strong month on soybeans. Now, corn is looking not too shabby itself. I mean, here's your widening out, ascending uptrend channel. That's really, really bullish stuff. Very, very nice to see here. And this is last week's price action. It's not reflective of this week's current price action. So corn looking very good. Soybeans looking very good. Very tight Bollinger Band squeeze here. Orange bands are inside the Keltner channels. I think soybeans are going to rip. Wheat, we had a we did have a Bollinger Band squeeze. This is now fired off. Wheat is breaking out. Very, very bullish stuff on agriculture. We're firing off here on soybeans as well. And it's not just soybeans. You have soybean oil, soybean meal. I mean, all these names are looking very, very bullish. So it looks as though they're going to be breathing a little bit more here. Soybean oil, not as bullish as soybeans, soybean meal. Soybean meal is just rocket fuel right now. This is probably more bullish than soybeans. So interesting stuff. Let's continue on. What didn't we do? What didn't we do? I think we did it all. Let's check in with yields. Yields are bouncing here. I want to go to a 4-hour chart, 10-year. Now, what's important here, we're going to go to a chart of this in a moment. What's important here is that the 10-year yield broke out last week. So it may have been down on Friday. It may be down today. The however is we broke out last week on the 10-year yield. That is significant. And when you're looking at this chart here, actually, you can see it on this chart. The breakout last week, it was a breakout in time. We just traded sideways. We broke out above this upper band of resistance. Momentum may be changing here. Let's go to a 4-hour view. Yeah, I mean, we just started this 4-hour bar. When did this open? That opened only a few minutes ago. So this is a fairly bullish setup on the 10-year. Let's take a look at volatility. That's probably down. It is down. But the weekly chart of VIX is very, very ominous. Descending wedge formation, and that usually gets resolved up. And that would be bearish for the S&P 500. Here's the NQ. I'm just checking back in. We are now up by only 0.26%. Let's go to the Russell 2000. It was extraordinarily strong today. So this was up 0.69%, now up 0.52%, respectable day nonetheless. Let's just check in with gold. Now there's a myth out there that gold can't rally with the yields. I've gone over this before, but for the benefit of those that have not heard this, I've gone over the chart of gold versus yields going back to 1970s into the early 1980s. Yields and gold went up in tandem. What didn't go up? The dollar. The dollar crashed. So it didn't crash per se. It declined in value. So what is the market saying when you have yields that go up along with the price of gold? The market is saying that the Federal Reserve is behind the curve. They are not raising rates aggressively enough. It's saying that right now. Gold is at just off of all-time record highs. What is that saying to the Federal Reserve? It's saying, hey, you're paused for a long period of time. You're way behind the curve. You got to raise rates. This is why I have been so dumbfounded by the fact that people think that we're getting rate cuts. Why would we get a rate cut? We have GDP in excess of so-called 4%. Inflation on the rise. We're looking at gold up. Silver on the day, 4.44%. Oil up. Nat gas up. Ag up. What else? What other information do we need? I don't need the PCE report. I don't need the CPI report. I don't need the PPI report. I don't need it. I look at these charts, and the charts are telling me, they're telling a story, a violent story. Right? It's got violent background. The Federal Reserve is not doing its job. It's behind the curve. And the reason why we sold off last Thursday is because Jay Powell pretty much said, well, actually not. The other Fed governors were talking about rate hikes, not rate cuts. Last meeting. That was only a couple of weeks ago. So that segues us into first, let's talk about seasonality. Folks, we're using TrendSpider, 35% discount code below. Use that link. How they may even have a better deal because it's Memorial Day. Go check their site. Use the link below. If you're watching this on Twitter, go to my bio section. There's a link up there. You can go in and you can click that link. There's a bunch of tabs, but you'll see TrendSpider there. So SPY monthly chart. I got to say, looking at this chart, I think that we go up. Price target, fractal resistance up at 573.70 on the SPY. I think we could still go up here on the SPY. Seasonality wise, going back 31 years, this is pretty consistent. If you go down to 15 years, very, very consistent data. Is that May, a very strong month. June, 50-50. So not as great of a month as May, nowhere near it, as a matter of fact. And if you drill down to, what is 1999, that's 25 years. 25 years, June, a little bit worse. I think 2009 is 15 years. Yep. June is up 53% of the time. Okay. As we look at the weekly view, though, we still have some wind at our back in terms of weekly seasonality. That all goes to hell in the handbasket here. I don't know the date. It's the 25th week. I would Google that. But we have a pause. So I titled this video, do you sell in May and go away? No, that hasn't been the case for a very, very long time. And that's why I went back 35 years on this chart. Does volume dry up? Sure, it does. But you go back, let's go back further. Actually, on a weekly, you can't do that. Monthly, we can do that. Let's go back to, 1993. That's all the data that we have. July is up 61% of the time. August is up 61% of the time. Better than 50%. So no, you don't sell and go away for those months. Now, when you get into the autumn, that changes a little bit. September is a bit wonky. October has been notorious for high volatility. So taking a look at the Qs before we leave here. Now, unlike the S&P 500, the Qs are, we added to short positions on the Qs last week. The Qs are at resistance. They have a quarterly resistance level up here, right? On a monthly chart, I can overlay yearly resistance. There is none. Quarterly resistance, we have some resistance up there. So on the month, very strong month. This is a breakout. Let's get rid of all these, start over again. Okay. So there's our breakout. Can we get a check back to 436 in June? I think we do. I think that's exactly what's going to happen. We're at resistance, not quarterly resistance. You have fractal resistance, which is up at that quarterly resistance level. So we may press higher here, but I think that we should be leaning into the short side as we probe. If we get up into those quarterly resistance levels, probing to the short side with an expectation that we're going to get a check back. We also know that we have a couple of weeks of seasonality going back 35 years where we can get some weakness. Now, in terms of economic data coming out this week, not a ton, but what does come out matters. Tuesday, a lot of Fed heads coming out. Consumer confidence, that's a 10 a.m. report. Keep that in mind. Fed beige book on Wednesday. Really doesn't get hot and heavy until Friday. Friday, we're going to get PCE. This is the Federal Reserve's favorite measure of inflation, not CPI. It's the PCE. So, it's a very important number. The street is going to be glued to this number. We may have a quiet week, bias to the upside, and then we get this report out on Friday, and we'll see what happens. So PCE on Friday, big number. In terms of earnings, not a lot here. Earnings season, by and large, is over. Nothing real. So you have CRM comes out on Wednesday. Best Buy, Costco after the close Thursday. Other than that, quiet week. Earnings now take a back seat to economic data. Now, I'm going to refresh this. Before I do, keep an eye on this. Ease 49.4%. We're still there. So after the Federal Reserve released their minutes for the prior meeting, the probability of an ease dropped by 10% like that. It's continued to drift down below 50%. So why does the equity market continue to move up? One is hopium, hoping that we're going to get a Fed rate cut. I keep going back to this. I think it's just elementary school stuff. Economics 101. If you go to the Keynesian school, perhaps not, but if you go to the Austrian school of economics, you know that government creates inflation. It's the government that creates the inflation. They want to blame the bad manufacturers and the bad energy companies, but in reality, it is the government that does it. So you have two things that are driving this equity market up higher right now. Hopium and something else. We're going to go to it in a moment. Now, the more that this drifts down lower, the harder it's going to be for the equity markets to continue to press up higher, and especially in this very, very light volume environment. I'm going to show you in a moment. Volume has been horrible. To be fair, down volume has been weak as well, but up volume has been non-existent. So you're not seeing a lot of institutional demand for equities at these price points. And I just mentioned you have monthly resistance. Qs are right at it right now. You have quarterly resistance just beyond that resistance level. If you don't have buyers, institutional buyers who have technicians on their staff that don't want to buy stocks 5 percentage points lower than where we were a couple of weeks ago, then why are they going to want to buy stocks up and into two major resistance zones? It doesn't make sense. There's too much supply above. Sean, welcome. Welcome, pal. So November, they're still pricing in a rate cut. If they do go in 24, it's going to be December. I've said that all along. All right, so I always find these amusing. Most of the times, 90% of the times they don't pan out. But I thought this one was pretty cool because we have the potential. This is 2024 present day, and this is the 2008 peak. And you can see that they don't go lockstep, but they certainly are rhyming, these two price patterns, to 2024 versus the 2008 peak. And at current, we've broken out above prior resistance, and we could quite very well proceed lower. We could just trade sideways. So we don't want to say that this is going to happen. A lot of people post this stuff on Twitter, and it's like, boo, get scared and sell your stocks. I'm not saying that. I just thought it was interesting, and I thought I'd share it. It's by no reason whatsoever would I go dumping shares based upon this. It's just something, a little bit of information to tuck in the back of your head. Simple as that. Now, moving on to more fact-based stuff. We started talking about this earlier, about the two reasons why the equity markets are going up higher, right? You have hopium that the Federal Reserve is going to cut. Remember, March was 100% locked. They were going to cut rates. That never happened. May was guaranteed. Now we have, we know June is not going to happen. July is not going to happen. September is not going to happen. November, maybe, but I doubt it. December, I still think it's, if they go, it's going to be December. If they cut, it's going to be December. And oddly enough, that would have been, December is the month where a lot of key things happen. It was the first time in 10 years or so that I think it was 2016, December 2016, and Yellen raised interest rates for the first time. It was the first hike for like 6 months. And then we went on that long interest rate hike spree. I'm sorry. Then we went into 2020 and we got all the cuts. My apologies. That was inaccurate information. We would have continued on that spree were it not for COVID. Okay, so the other component out there is Treasury. Treasury is manipulating the bond market right now through their general account fund. And I'll talk about that in a moment. I'll explain how they're doing it. But this is odd. I was going to talk about this, and this got posted on Zero Hedge from Peter Schiff. The Fed versus Treasury, all roads lead to inflation. The Fed raises interest rates to make loans less attractive and bring inflation down. But the Treasury has its own set of magic tricks to artificially stimulate or tighten the economy as well. So I'm not going to go through this chart. It's just a series of bonds that are out there. When interpreting Treasury yield data, remember that this market is being heavily manipulated by Yellen. She's conducting Treasury versions of both Operation Twist and QE. Both of those were monetary easing policies. Over-reliance on short-term issuance and now buyback short-term premium is now virtually nonsensical. So this is the yield curve. She is taking supply out of longer dated maturities and bringing on or buying up short dated securities, and that's driving yields up higher. So if you're wondering why the yield curve still remains inverted for the longest period of time in history, it's because of the Treasury and what they're doing. And of course, this provides liquidity for the equity markets. This is why the stock market is moving up higher, despite the fact that you have yields breaking out. While this occurs outside the halls of the Federal Reserve, Treasury buybacks are merely a different way to print money from nothing. The U.S. is running deep, sustained fiscal deficit with no true debt ceiling. So Treasury buys back its own securities by issuing new debt, which it creates out of thin air. With spending far exceeding revenue, inflation, higher interest rates plus more debt means fiscal deficits accelerate inflation. The short-term stimulative effect of this somewhat offsets the Fed's tightened monetary policy, but digs a deeper hole longer term. So you're going to tell me that Jay Powell, with the Treasury doing their own quantitative easing, is going to cut rates? I don't think so. Now, one thing that Jay Powell promised that he would do in his last presser was, I didn't go over this last Thursday. He was going to reduce the amount of debt he's rolling off the balance sheet. And it kind of now makes sense why he went that route. First, it was to throw some meat at the markets, because the less that the Treasury sells off of their balance sheet, here's their balance sheet, ballooned after COVID, ballooned after the financial crisis. This is only $600 billion back here. Now, we hit a high of nearly $9 trillion. We're only back down to $7.353 trillion. It's so insane. So you could see last week that 7304, they only lightened up They hardly sold any treasuries last week. So that's going to help buoy the market a bit, because what's happening here is the treasury balance sheet. In red are their liabilities and capitals. Liabilities and capital liabilities, deposits, blah, 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 blah. So here's their capital in short. And they're running out of capital. Here it is in billions. They were up nearly $1 trillion. This is all those bailouts for, the what do you call it? The Inflation Reduction Act, blah, 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 which only created more inflation. So all that money is being spent down now. So now what Powell needs to do is take, because they're running out of money, they need to take the baton away from Yellen. And now they need to pick up the pace to keep this party going strong. The only problem is it's just going to keep inflation going up higher. So, and the reason why we know that this is going to run out very, very quickly is because the debt, the interest on our debt comes out of this fund. And that is now over $1 trillion a year just to pay the interest on our debt. And they're at $720 billion. So here it is, the chart. The Treasury, I should have started off with this. The Treasury General Account is the government's primary operating account and is often called the government's checking account. Simple as that. That's this. Now, what Yellen's doing explains quite a bit, because you'll remember going back here, this is the 10-year yield yearly chart with the S&P 500 overlaid in blue. Back here in 2018, I should say really here in 2019, we went into free fall. And this was COVID here. This was not COVID. This was COVID. And why were we going into free fall? This is the taper tantrum. And yields were pulling back. Equities were allowed to rally. But they did do a pullback back here when yields got up to 3%. And I remember saying for the longest time, once yields get up to 3%, what's going to happen is that equities are going to pull back. And frankly, I was wrong, because I had really no idea of what the Treasury was doing here. I kept watching this, and I kept watching this, not watching what the Treasury was doing. My bad. We learn from our mistakes. So if you're wondering why, yields could press up higher, new yearly higher highs. I shouldn't say higher highs. I scratched that. We have a breakout on a yearly time frame in 2022, new multi-year highs in 2023. I think we're going to hit new highs in 2024. We're not there yet. But look at the S&P 500. It just keeps moving up higher. That's because of Treasury. And it's also because of a few stocks, only a few stocks. Stock concentration has accelerated. The top 10 companies' share in the S&P 500 has reached a new record high of 35%. This is the highest record percentage in 50 years. It now also exceeds, and boy, I remember this bubble, the 2000 dot-com bubble by 8 percentage points. Meanwhile, NVIDIA alone has contributed to 39% of the S&P 500's market cap gain year to date. Think about it. Think about that. This market cannot function without big tech. So very, very true. And here's an example. These are earnings year over year, S&P 500. Information technology, up 25%. I think this has tech in it as well. I'm not sure exactly what this sector is here. Utilities, I'm very surprised, are up this much with yields rising. Very, very surprised. But it's info tech, and this has got to have tech in it. Now, in terms of how expensive this market is, we remain, I'm not going to spend too much time here, strongly overvalued. This is the Buffett indicator. We remain at 2 standard deviations beyond historical norm. Very, very expensive. Does that mean you sell stock tomorrow? No, but just be aware of the environment that we're in. We've only been up here a couple of times in recent decades, and it didn't end well, right? Back here, COVID. Actually, no, I apologize. This was 2021. Then we went into the 2022 bear market. 2000, that was a multi-year bear market. And before that was 1968, 1969, that area. And I was alive back then, but certainly don't remember what happened to the market. So in terms of Schiller PE ratio, 34.71%. Now, you may be saying, Bob, you're looking at a rearview mirror. I'm sure earnings are going to accelerate. We're going to grow into this multiple. Okay, let's take a look at forward-looking multiples here. The forward 12-month PE ratio for the S&P 500 is 20.5. It's above the 5-year average of 19.2 and above the 10-year average of 17.8. Not egregious, but relative to the 5 and 10-year period, forward-looking basis, we're expensive. Now, when you're a sage of Wall Street like Warren Buffett, and rest in peace, Charlie Munger, you watch what these guys are doing because they're very, very savvy. And you have Warren Buffett sitting on a record 157.2 billion in cash. This is the highest cash level for the company since 1991. So they must be talking about, obviously, in aggregate, this is a high level. As a percentage of cash relative to the equity stake, I don't know if we're all-time highs, but certainly we've grown since 1991. So that's a given. Oh, hey, Bob. Hope you enjoyed your weekend. Same to you, Dane. Can you look at Okta? Of course. They report earnings day after tomorrow. You bet. Joel, great place to enter Starbucks. Short position last week. Let me take a look at that one. That was on our extreme oversold watch list. I'm glad you reminded me of that. I'm glad you reminded me about that one. All right, let's talk about the market, right? So right now, they have in the futures market, they have the E-minis and the Qs, or I should say the NQ up. They're green. But we cannot forget about Thursday. Thursday was an event. And a lot of people are forgetting about it. Like, that's a one-day wonder. It's a blip on the screen. Don't worry about it. I worry about it. So we shorted with put options intraday the Qs. And I took them off the next day. I left some money on the table. But we made a profit. And then I started buying up the SQQQ on strength, because here's the setup that I'm betting on, is that we're going to do one of these. I think we could break this support level. Doesn't mean that we can't continue up higher, continue to retest what was prior resistance, should now act as the rising upper band of resistance. That's just the way it goes. But with volume the way it is, the lack of volume is just astonishing. And the fact that we've already identified that we have strong monthly resistance above on the trip Qs where we reversed off of, let's go back to that chart. We tapped it last week and they sold into it. Monthly resistance. So I think it's plausible that we could break here. Am I overly confident? Did I get crazy short? Did I go dumping my longs? No, I did not. let's take a look at how we closed out the day on Friday. Not a great close. Let's check out the S&P 500 daily chart. Again, outside reversal bar, bearish engulfing bar. If you're not familiar with the terminology I'm using, there's a video tutorial, 5-part video tutorial, link below. My top 5 favorite candlestick patterns, free. Take advantage of it. So inside bar, good recovery on Friday. But again, are we potentially setting up for a break here? Actually, we've already broken down below support on the S&P 500. We did that several days ago. There's no volume. Just no volume. And the other thing is that the new highs versus new lows they're trending lower. Yet this is the excuse me, I meant to say NASDAQ, not the S&P. The NASDAQ composite continues up higher. That brings us back to this chart here. Too few stocks driving an entire market up higher. I'll leave this as good news. Let's continue with the bad news. This is a monthly chart of the Dow Transports. And I got to say, I drew these lines a few weeks ago. We have a monthly cup with handle formation. However, we failed to break out back in March, dropped back down to the lower band of support in April, and on a weekly time frame, on the month so far, we're well off the highs of the month. And on a weekly time frame, there's the Dow Transports weekly chart. While you have the Dow Jones overlaid here in black, putting in new higher highs, the Dow Transports are not confirming the move higher on the Dow Jones Industrial Average. That does not pass the Dow theory test. And you can take a look at the Dow Transports RSI. It's trending lower. It's losing momentum. So while I had a lot of hope for a breakout here on the transports, it's becoming less likely. Now, I'll leave it off on a good note. When do I get scared here? I talk about this all the time. This is being manipulated right now. This is the yield curve. You could see that we are in a precipitous free fall the past several weeks. We've been being blocked from breaking out. And until such time as we begin to break out above this upper band of resistance, I can't get overly short the market, and I'm not going to dump my stocks. Not quite yet. We had like a 27% profit on Philip Morris. I sold that, booked some profits because it was extended. We're probably going to re-enter that before the ex-dividend date on the 14th of June. So I could do that tomorrow, cheaper. So let's do some chart requests, and I will give you folks back to your families and friends. Joel, I'm with you, Bob, going short near the top of that Thursday breakdown candle. Yeah, I mean, if you're going to enter a short trade, you got to be able to say really, really quick, where's my stop? And that Thursday reversal bar, if we break out, here's the S&P 500 again. We break out to new higher highs. You got to get out of that short. It's that candlestick, that bearish reversal is negated. It doesn't exist anymore. It's history. It doesn't exist. So I think it's a good risk reward bet at current to have a toe in the water to the short side. All right. So first chart up is going to be Fossil. I haven't thought about this stock in years. This is for Ramon. Years. Monthly chart. This used to be a high flyer, man. When did this peak out? April of 2012. Look at this double top. And this is the beauty of the automated trend line, folks. Beautiful. Once we broke here in January of 2014, you had to be out of this thing because we broke out above. This is a quarterly resistance level and dash line on a monthly chart. If it didn't hold that after that breakout, you had to be out of this. And man, what a bloodbath. Where do we peak out at? Around $139 per share. So let's bring us to present day. So after many, many years of being in a bear market, it stopped going down. That's step number one of the healing process. You got to stop going down. And we are just drifting here. It looks as though we bottomed out maybe here in November. Volume, you had some selling pressure back here in March, but we closed off the lows of the session. What's important is that I'm going to take this line off. I'm going to put it back on. So this is the automated trend lines. Where's the button? Here it is. I'm going to take them off. And you can see we broke out above this line in blue. At current, we have a couple of trading days left to go, but it's looking pretty good for the shares of Fossil. So what's our next price target, assuming that we do close above this resistance level, current potential support level at $1.05? Well, I'd be a buyer next month, not this month, next month on a retest of $1.05 per share. And in fact, what we're going to do is we're going to set up an alert, touch, bounce, breakthrough. Matter of fact, I don't care if it breaks through. We'll keep a little bit of sensitivity on there. And we'll keep this active for a few days. Okay? RSI has now gone from putting in lower highs and lower lows to putting in higher highs. EPS still, revenue still weak. But I pulled this up because I hadn't looked at Fossil in a long time. I was curious. And fundamentally, it's not a leadership name, obviously, but this jumped out at me. EPS change last quarter was up 51%. That's not making money, but it looks as though things are improving. And it's very, very volatile for traders. A beta of 2.15 is extremely volatile. So that tells me there's probably a fairly large short position in this name. And these guys, you have professional shorts that are out there. These guys just fall asleep. Once they get a winner, they leech every penny out of the trade. And at times they just fall asleep at the switch. They don't know that this thing stopped going down. They should be getting out of here because they're setting themselves up for a short squeeze. Now, looking at seasonality, what are we doing here? 30 years, May, we're only up 48% of the time. June, up 53% of the time, with April being the best month out of the year. March, the worst. Actually, sorry, September is. Let's go more present day, though. Because remember, this encapsulates a massive bull market that peaked in 2012. So let's go to 2013. Now the story changes quite a bit. 11 years of data. March, by far the worst month. May, not a good month. Whereas June is one of the better months out of the year. So seasonality wise, you're setting up for a potential run here going into June. Now, this week we're up 64% of the time, up 73% of the times the following week. And here's your seasonality squeeze in June. So I think this is possibly good for a trade. I want to see it pull back in June, do a retest, accumulate. New higher high, a close above VWAP, which is a current 1.76, accumulate more. Then I'd probably be selling at between 2.26 and 2.46. If we close above those marks, I'd buy back in. But you got to expect you're going to have a ton of sellers up there. So that's the trade on Fossil. Where's my other? Oh, I got to go to the members area. They always log me out. My own website. Okay. All right. Steel, U.S. Steel. Monthly chart. Now, this is an arbitrage type play. They're trying to, I think it's Nippon Steel. I forget who the company is over in, I think it's a Japanese firm looking to buy U.S. Steel. I didn't follow the transaction all that much. I just know that the government put a halt to it. So obviously the shares of U.S. Steel have pulled back, but this is looking pretty attractive, to be honest with you. We're pulling back to quarterly support at $34.54 per share. I don't know if I'm spelling that right or not. So at some point in time, this is going to get squeezed. We have a commodity bull market going on, and steel, I don't think is going to be exempt from that. I think it's under pressure due to the fact that we have a kibosh on that merger. Doesn't mean the company's going out of business. Now, looking at seasonality, we're heading into a very seasonally favorable period of time. I mean, April, May, horrible months for U.S. Steel, and then we grind up higher. September being the standout, which is not a wonderful month, but we have some good summer trade here over the past 11 years. And we can go back further here. This is an old, stodgy company. Going back further, 18 years, August is a problem month. So you're looking at June, July being a consistently strong couple of months. So if they sell it off to that support level, I'm a buyer, maybe sell puts, do whatever, and then enjoy some seasonality to the upside. You bet, Ramon. Okay, let's wrap it up with soybeans. I was in this last month. I bought the futures on soybeans. I got stopped out of the trade. And I'm really new to futures trading of agriculture, so I kept really tight stops. But I did know that the seasonality here was quite favorable. You also have a squeeze setting up. So we'll go over both in a moment. So this is a monthly chart. We are breaking out of a downtrend. When you take a look at a weekly chart, as a matter of fact, let's bring up this. Weekly chart of soybeans. Very, very tight Bollinger Band squeeze here. And we're firing off at current. Volume, awesome. And when you take a look at seasonality, this is my favorite part. March, April, May, horrible months going back 13 years. But June, and well, not so much July, but June is a very strong month, the best month out of the year, up 67% of the time. So I really like this trade on soybeans. Now, wrapping it up with two names, Octa. Seasonality, May, very strong month. Not so great in June. It gets much better in July. You have a cup with handle formation here. Let me see if I can blow this up a little bit. Let's take this off. As a matter of fact, let's bring that back on for a moment. Yeah, I can't find it. I have too much stuff going on here. Oh, here it is. Revenues are rising very, very favorably here. So that's nice. So let's take this off again because I want to point out something from a technical perspective. Can't find it. I got to clean this up. From a technical perspective, you have a very, very nice cup with handle formation. Here's your cup, and then you have this going on. Downward sloping handle. And you can see, if we could expand this out further, that we're creating the right side of this cup with handle formation now. So I think that this could break out. Revenues rising, technicals firming up here, building the right side of a cup with handle formation on the monthly chart, going to a weekly chart. Rough week last week. We rejected at the upper band of resistance, daily chart. This could be a buy right down here between 95.87 and 94.18. These are the automated trend lines saying it's nearing very strong support. Octa looking bullish, even though the chart is saying that it's under some pressure. I wouldn't worry about that too much. And don't forget about seasonality. SBUX. All right, so they reported horrible numbers. And the shares were punished. The however is that we bounced off of quarterly support. Let's see if there's any yearly support down there. No. And we have reversed. Here's their revenues. Look at the plunge in revenues. Weekly view. You can't ignore quarterly support. And you can still see it here in dashed line. We closed back above quarterly support 3 weeks ago now. But is it a dead cat bounce? Not quite sure. I would not short this yet. I would short it on a break of this quarterly support level here. I only care if it closes down below it. No sensitivity. We're going to keep this active because it may take a while for this to occur. And our alert is set. And those alerts are up here. They now have a knit widget for it. I don't need this though. Okay. Wrapping it up. Let's go to a daily chart first. I'm not a buyer here. I wouldn't short it yet, though. I wouldn't short it yet. That's it. That's it. We're done, folks. Happy Memorial Day. Have a profitable trading week. Have an awesome remainder of your night. Thank you for being here. Like, subscribe. You know the deal. Don't forget Trend Spider. 35% discount code below. Use the link if you're watching it on YouTube. The link below. Twitter on the link above. Talk to you soon. Be well.